Okay, hello everybody and welcome to the Vincent's tax update for June. We will kick off straight away. Just an important message for you all. So while every effort has been made to provide valuable, useful information in this presentation, this firm, any related suppliers or associated companies accept no responsibility and any form of liability from reliance upon or use of its contents. Any suggestions should be considered carefully within your own particular circumstances as they're intended as general information only. And then before I begin, I would also like to acknowledge the traditional custodians of the land on which I'm presenting from today, which is the land of the Turrbal and Yurruga people, and I pay my respects to their elders, past and present. I also extend that respect to Aboriginal and Torres Strait Islander peoples that are listening in today. So, hi, my name is Jenna. I am a manager here at Vincent's in the business advisory team. I'll quickly pop my contact details on the screen just in case anybody needs them. So we will potentially take some questions during the presentation today. Pop them in the chat pod if you have any, and I'll see if I get time at the end to address them. Otherwise, I'll give you a call or email later. So on the agenda for today, we have year-end tax planning. So we're going to first have a bit of a look at some year-end tax planning matters for businesses, personal individuals, and some other matters that you should probably look at before year-end. I'll then briefly touch on some reminders that will be important once 30 June kicks over. And then we will have a bit of a look at 100A in our little tax topic discussion. So year-end tax planning for 30 June 2022. For businesses, we're obviously generally looking to decrease our taxable income, make sure we're paying the least amount of tax we possibly can. So there are a few different things we can look at in terms of trying to minimize that taxable income in the 2020 year. So first of all, one of the things we look at is business income. Can it be deferred? If you have some invoices coming up and you're worried about taxable income this year, and they can potentially be deferred until next year, post 30 June, something that you can probably have a look at and consider whether it's appropriate for you. The second thing we usually take a look at are business expenses. So it is always important to review your business expenses and make sure that the expenses have been paid and incurred in the current year. Also making sure that you've met all of the requirements to actually deduct the amounts. So things like salary and wages being paid, making sure you've met your PAYG withholding obligations so that you don't have any limitation on deductions. Similarly, in that vein, making sure that your superannuation contributions have actually been paid to appropriate super funds. If you are looking to deduct your 30 June quarter superannuation payments to employees, it will be important to make sure that those amounts are paid and received by the funds prior to 30 June. Another thing to keep in mind when looking at business expenses is also have a think about whether there are any prepayments that you can make that you could deduct in the current year. So a lot of small businesses and even now medium-sized businesses have been given the ability to deduct prepaid expenses where the service period relates to the next year. Certain expenses like interest, insurance, things like that, if you can get them in, pay them before year end, that's great. The next item I would probably be taking a look at in my business tax planning is review of trade debtors. Having a look at these items, seeing whether there are any trade debtors that are no longer receivable, they have gone bad, and actually writing them off prior to 30 June to ensure that you're getting any deductions that will be available and writing those amounts off. Simply looking at them and saying they might be doubtful and providing a provision for them is not enough to have that claimed as a bad debt deduction in the current year. The next item I will bring up for business taxpayers is in relation to depreciation and capital works. So first point I will note, temporary full expensing has been extended. So it was introduced back in October 2020, basically as part of the COVID measures that all came through around that time. So it is applicable for the 2022 income tax year. And as I said, has been extended for the full 2023 income tax year as well. What this means, in the current year at least, if you were considering making some significant or even smaller equipment purchases, things that you would use in your business, if you're concerned that you might have high taxable income, it may be worthwhile looking at making these purchases prior to 30 June. Obviously, with any type of measure, there are some limitations on the types of assets that you can claim temporary full expensing for. There are limitations on the entities that can do this. And there are also certain rules, such as having to have assets installed and ready for use by 30 June, that you will need to meet to get the full upfront deduction. What I would recommend is, if you are thinking about making purchases, and this is something you might want to look at, definitely have a chat to your advisor about what you're looking at and make sure that you'll meet all the conditions to get that upfront deduction. I would also take a look at any asset registers prior to 30 June and have a look and see if there's any assets that are gone, no longer used, obsolete, destroyed, things like that, that maybe you might want to be writing off prior to 30 June. Another thing to keep in mind as we approach year end, especially with a lot of these temporary full expensing, immediate asset write-off deductions that have been around for a while, if you're looking at selling assets, make sure you've considered the tax implications of that sale. If the asset has previously been claimed under temporary full expensing and you go and sell it, you will be subject to tax on the full amount of the sale. So something to keep in mind. If it is an asset, you can wait maybe a couple of weeks to sell in the next year. If you're worried about tax this year, definitely something to have a look at. And then lastly, I'll just briefly mention capital works deductions. If any of your businesses or entities are holding properties or you've purchased new properties, have a think about whether it's worth getting a QS, or quantity surveyor report, now so that you're ready for year end and you can fully capture any deductions that you've got available to claim in that area. Continuing down and looking at trading stock, this is just a reminder that you need to make sure you're doing, or you've got all your stock takes scheduled in for year end to make sure you're accurately capturing your stock levels at 30 June. Also, make sure you're reviewing your stock for any obsolete stock that we can be writing off at 30 June to ensure that we're getting deductions for that. And then my last reminder for business, especially corporate type entities, the tax rate for 2022 has gone down to 25% if you're a base rate entity, or still remains at 30% if you're a non-base rate entity. Excuse me. Okay, looking at tax planning at year end for more personal taxpayers. So one of the things to look at if you're a personal taxpayer is, if you've sold a number of capital assets during the year and you're worried about capital gains, things like that, potentially worth having a think about whether you have any capital assets you were looking to sell that might be able to crystallize capital losses for you that can be used to offset those capital gains. Alternatively, if you haven't actually sold any capital assets yet, but you're worried about the gain, think about whether it's worthwhile delaying that sale into the next year. One of the other things to keep in mind with CGT capital assets too is access to the CGT discount of 50%. Just making sure you've held that asset for 12 months. Otherwise, you may miss out on that discount. I will raise too, the ATO every year come out with a number of things that they are looking to focus on when they're reviewing tax returns for any given year. This year, they've specifically come out and said that they will be focusing on capital gains events, specifically expecting gains from crypto, property sales, share sales, things like that. So if you are going to be, reporting any transactions in this area, just know the ATO are watching. And if you think they don't know about your transaction, they probably do. The next area for personal year-end tax planning would be just having a look at deductions, making sure you've paid any membership fees, union fees, other work-related type expenses prior to 30 June so that you can access any available deductions. Considering whether there are donations that you are looking to make to deductible gift recipient charities. Also keeping in mind, if you're in a partnership, making sure that the deductions are being made by the person with the higher taxable income to make sure you're getting the full advantage of that deduction, as well as making a lovely donation to a charity. Other deductions to keep in mind, obviously with COVID-19 lockdowns and things like that continuing to disrupt the workforce throughout the 2020 income tax year, it's good to start thinking now about what type of deductions might be available to you if you were required to work from home. The shortcut method that was introduced during COVID of the 80 cents per hour still remains available for 2022. It covers expenses like telephones, interest, electricity, and depreciation of furniture and equipment. There are still alternative actual methods, so it's probably worth having a sit down, thinking about what you can claim, and then working out which deduction will give you the most benefit, which calculation method is the best for you. Now, this is another area, again, where the ATO have indicated that they will be paying particular attention to deductions that are being claimed. Again, obviously, with people working from home, they expect to see a lot more home office, home working expenses, things like that. In correlation, they're also expecting to see reductions in things like uniforms or laundry. If everyone's working from home, it kind of makes sense that those things might decrease. So just making sure you're able to substantiate your claims and they make sense is probably the key to making sure you don't have any snags with the ATO. The next item, sorry, the throat's dying, we'll have a look at for personal year-end tax planning is superannuation contributions. So contributions can be made to super, basically split into two categories. You've got your non-concessional contributions, which are made from after-tax income. There's a cap of $110,000 per year. With these contributions, no tax deductions available. In relation to the other types of contributions, our concessional contributions, these include contributions made by employers or personal contributions that you might make that you claim a deduction for. These contributions are capped at $27,500 for the 2020 income tax year. And again, income tax deductions are subject to meeting the eligibility conditions. So broadly, the tax deduction for personal superannuation contributions is available to anybody up to 75 years of age who provides their superannuation fund with the relevant notification of intention to claim an income tax deduction and then receives an acknowledgement of that deduction from the fund. So it is important to note now, while we have the current year cap in place, there is actually the ability to use unused components of your concessional contributions cap from prior years, from 2009 years and later, I should say. So a taxpayer is able to use these unused concessional cap contribution balances, provided the balance of their super fund at 30 June in the previous income tax year is less than $500,000. So, for example, my superannuation balance at the end of last year was less than $500,000. Let's say in 2021, my employer paid me, or paid on behalf of myself, my super fund $15,000 in employer contributions. So that would be reduced from my concessional contributions cap. I have 10, and last year that cap was $25,000. So I have $10,000 of unused concessional contributions carried forward that I could use in the future. Moving to 2022, let's say my employer then paid another $15,000 in employer contributions to my superannuation fund. With this year's cap of $27,500, that means I've got an unused balance of $12,500. So combining last year's 10 and this year's $12,500, I could potentially make deductible contributions to my superannuation fund of up to $22,500. So again, that's provided I notify my superannuation fund that I'm actually making these contributions and I intend on claiming the deduction. If this is something that you're considering doing in making personal contributions to super, please make sure you're checking with if it's an APRA fund, you're checking the due dates that these payments are required by. They'll definitely be required by 30 June. You'll find some of the APRA funds actually require payment to have been received on an earlier date. So just make sure you're checking before you go making contributions on 30 June and then not getting a deduction for them. The other thing to keep in mind as well, if you're making personal super contributions, is that there is an additional Division 293 tax that should be kept in mind. Basically, Div 293 tax applies where an individual's taxable income combined with their concessional contributions is greater than $250,000 and applies 15% tax to the concessional contributions. So again, just something to keep in mind. The last personal tax planning matter that I thought I would discuss, which I think is probably a big question everyone has, because I don't know about you, but I feel like I've done thousands of COVID tests over the past couple of years, is the deductibility of COVID tests. So basically, where a test is used for a work-related purpose, such as determining whether you could attend or remain at work, a deduction is available for the cost of the test. Deductions are available for both PCR and RAT tests, where you have records to prove the costs were incurred, so a receipt, and where you can prove that you've taken the test for work purposes. One of the things to keep in mind with things like RAT tests, if you've gone out and bought a big box of 10 and it's cost you $100, keep in mind you can only claim a deduction in relation to the amounts that relate to your work COVID tests. So as I said, if I bought 10 and they cost me $100, I used one test for work purposes. My family used the other 9 just to check whether they could go out on the weekend. They wouldn't be deductible. So keeping that apportionment in mind. And since I've touched on a couple of matters briefly that the ATO have noted as focus areas, I'll probably just mention here. There were 4 areas they had to focus on. So one was capital gains, one was basically justifying your deductions. The other 2 are making sure you've got good record keeping. So the ATO, again, I think they do this every year though, said that if you're found to be deliberately increasing your refund, falsifying documents, can't substantiate your claims, the ATO are going to be looking at you and dealing with taxpayers and applying penalties. They've also issued a reminder that if you're using the online services or any other kind of ATO pre-filling documents to prepare your personal tax returns, data from banks, dividends received, private health insurers, a lot of that won't be received until later in July, August. So you either need to make sure that you've got the information yourself or wait for that information to be able to pre-fill from the ATO. Their last focus area is really around rental properties, both income and deductions available. If you're a rental property owner, just reminding you to ensure you're including all rental income in your tax returns each year. So whether it be rental income, short stay, rental income, insurance payouts, even where you've retained a bond from a long-term tenant, all of that should be included in income. And then obviously, just ensure you're exercising relevant caution in relation to claiming deductions, making sure they're valid claims relating to periods where properties have been rented or available for rent. Okay, and just some other year-end tax planning matters that we will have a look at. So always good to have a reminder that if you've been paying salary and wages, always check that you are compliant with relevant state payroll tax registration and any kind of grouping requirements are considered. So in Queensland, an entity is required to be registered for payroll tax within 7 days of the end of the month in which wages exceed $25,000 per week. Now, this doesn't necessarily mean that you'll be paying payroll tax, but that's when registration is required. In Queensland, payroll tax will kick in some way when your salary and wages across any of your group and your annual wages exceed 1.3 million. And again, when looking at payroll tax, one of the biggest things to keep in mind are the grouping provisions. If you are operating a number of different businesses and a number of entities, there's shared ownership, there's shared employees, there's a good chance that for payroll tax, those entities will be grouped together and your annual wages will add up into the one number. So keep that in mind. Also in 2022, just thought I would briefly mention here that the loss carryback measures are still available in 2022. So we've discussed them in the past, but the loss carryback measures provide a refundable tax offset to corporate tax entities that can be claimed as part of the 2022 return. So eligible entities will get an offset where they've got losses that they can carry back to apply to earlier year income tax liabilities. So income tax losses in 2020, 2021, 2022 can all be carried back as far back as the 2019 income tax year. So, for example, if a company incurs a loss in 2022, it can choose to carry that loss back to the 2019 income tax year, where they may have had tax to pay, and claim a refundable tax offset of that tax paid amount. Now, it's important to note that won't require an amendment of the 19 return. This all happens within the 2020 income tax return. Thing to keep in mind is any kind of refund is limited to the balance of the company's franking account, and it will reduce the balance of the franking account upon refund. Moving on to trusts. So obviously all trustees need to ensure that any necessary documentation, resolutions are all put in place by 30 June or earlier if that's the guidance per the trust deed. Just make sure you're checking your deeds for those dates, just to ensure effective distributions of income in the current year. Special consideration of beneficiaries and things like that will probably also be important in 22, particularly because we've had a few areas the ATO are focusing on around 100A, and we've had a few releases this year, which I'll discuss later in the presentation, but they all stem from distributions from trusts. And then my last reminder is in relation to Div 7A. So just a reminder that private companies making payments or loans to shareholders or their associates should probably be considering their Division 7A position. So if Division 7A applies to particular transactions, payments, loans, there is the potential for deemed dividends to be accessible to the recipient of those amounts. Where Division 7A loan agreements are already in place, just making sure that you've made your minimum repayments prior to 30 June to avoid any shortfall being included as a deemed dividend. That concludes our tax planning. So moving along to reminders. So my reminders from 1 July 2022. Firstly, STP finalisation for those of you employing. Just a reminder that the finalisation declarations are due by 14 July, also my birthday. So just making sure your STP data is up to date and ready to go. Also with STP, we have shifted into phase 2. It officially started from 1 July this year. The move to phase 2 is really just the government continuing to basically streamline all the employer reporting amongst all the different entities. If you don't know what phase 2 means, or you're not sure if you're in it, check with your digital service provider and they should be able to provide guidance of where they're at in that system. A lot of the bigger providers, if they haven't been able to meet the requirements yet, have been given extensions, but just worth a check to know where you're at. So the super guarantee rate from 1 July 2022 is increasing from 10% to 10.5%. So just making sure that any payments of super that are made after 1 July apply a 10.5% rate. The other big change with the super guarantee, in prior years where a worker was paid less than $450 a month, they did not require superannuation to be paid on behalf of that employee. That's now gone. So basically from 1 July, any employee, no matter how much they've been paid, I should say employee or contractor, anybody that is being paid requires a superannuation contribution of 10.5%. And then my last reminder is probably a non-tax related one, but will impact a lot of people, is director IDs. So company directors are required to apply for a director ID. The director ID is basically just a unique identifier. Once you get one, you'll keep it forever. So when people are required to get the ID, and the timing of that is really based on when they first became a director. So directors appointed before 1 November 2021 have until 30 November this year to apply. New directors appointed for the first time between 1 November 21 and 4th of April 22 have 28 days from their appointments to apply. And from the 5th of April this year, intending new directors actually need to apply before they can be appointed. So at the moment, the Australian Business Registry Service is responsible for the Director ID initiative and managing applications and IDs. So I would suggest heading over to the Australian Business Registry Services website if you need more information and to apply for your Director ID. Okay, now onto our tax topic. So as I mentioned earlier in the presentation, trust distribution resolutions and consideration of beneficiaries and how they're going to be paid is definitely going to probably involve a higher level of consideration. Not that it hasn't always been, considered in detail in prior years, but it's just going to attract a little bit more attention this year, and especially from the ATO, all because of 100A. So Section 100A is in the old Income Tax Assessment Act 1936. It's an anti-avoidance provision introduced back in 1979, designed to prevent taxpayers from using trust structures to reduce their tax liability. So we've already seen from the early 2000s, the ATO has been looking into trust retention type arrangements. In the early 2000s to 2010, they had a look at bucket companies that were used often to distribute from trusts into bucket companies, but the funds stayed in the trust. From that, we received a lot of new guidance around Division 7A and unpaid present entitlements to private companies. From there, they've started to look at arrangements with trusts and individuals. So in 2014, the ATO published guidance on their website, basically alerting the public to their position on trustees and beneficiaries of a trust where a present entitlement of a beneficiary to a share of the income of the trust arises out of a reimbursement agreement. Now we'll go into this in a bit more detail soon. Since then, though, February this year, they've again provided further detailed guidance in relation to the ATO application of 100A, basically by releasing a draft taxation ruling 2020 D1, so income tax 100A reimbursement agreements. Oh, I've got a bit of a typo on my slide, sorry. They've also released draft practical compliance guideline, PCG 2022 D1, which is Section 100A reimbursement agreements and the ATO's compliance approach. They've also released a taxpayer alert, TA 22/1, which is all about parents benefiting from trust entitlement of their children who are over 18 years of age. So I'll spend a bit of time now going through 100A and what this all means. So basically, Section 100A will look to apply. We've got a little nice table here that goes through it. So stepping through the criteria, is there a Section 97 beneficiary who's not under a legal disability? So basically someone over 18 who's presently entitled to a share of income. So this is a distribution from a trust. Is there a present entitlement connected with a reimbursement agreement? So a reimbursement agreement being a provision of benefits, property, money, services for someone other than that presently entitled beneficiary. Was there an arrangement entered into for the purpose of reducing the income tax liability of someone? And does the arrangement fall under the ordinary family or commercial dealing? So basically, if we've got a present entitlement, paid or presently entitled individual, but the entitlement actually goes to someone else for the purposes of reducing a tax liability, there's a good chance 100A is going to apply. The only way, or the way that you kind of move out of this, if there is some kind of agreement in place, is if the agreement falls under the ordinary family or commercial dealings. So in explaining the operation of 100A, beneficiary presently entitled is basically just that distribution at year end. You are going to receive a certain amount of trust income. A reimbursement agreement is really an agreement that provides for the payment of money or the transfer of property to, or for the provision of services or other benefits for a person other than the beneficiary or the beneficiary and another person or persons. An agreement can be anything between an agreement, an arrangement, an understanding, formal, informal, doesn't have to be expressed, can be implied, doesn't necessarily have to be enforceable by law, but could be. But basically, it's any kind of agreement that falls outside of that idea of ordinary family or commercial dealings. So now you might ask me, well, what is an ordinary family or commercial dealing? At this stage, I think the ATO guidance is more around what it would not be. So agreements not made in the ordinary family or commercial dealings are, or kind of occur in circumstances where there are contrived type features as part of the arrangement, or it's unlikely that the beneficiaries will ever receive the entitlements. This might be because the fund has on-lent the money to someone else and it doesn't ever think that that money is going to be repaid. The funds could have been invested in a way that's not really consistent with the entitlement, or the funds are dealt with just in an inconsistent way so that the beneficiary couldn't even demand payment of their entitlement. Other circumstances that aren't really ordinary family or commercial dealings are where the beneficiary isn't really compensated for being kept out of the money, where the beneficiary isn't even informed of their entitlement. So there have been cases where distributions might have been made to family members overseas that don't even know that they have an entitlement. Also includes entitlements to the beneficiary that are subsequently returned, or other benefits or services are provided, whether by gift or otherwise by someone else. And then the entitlements are not remitted to the beneficiary, and there are strange reasonings around why this would be happening, having regards to the reasons that the distributions were made in the first place. And then just having a look at whether there are particular relationships even between parties, like the beneficiaries, the settlor and the default beneficiaries, whether there's something in there that doesn't quite fit. So that's really where the draft taxation ruling TD 2022 D1 comes into play, and the ATO focuses on the interpretation of 100A and tries to explain, the basic concepts of connection, benefit provided to another, the ordinary dealings exception, and the tax reduction purpose. So what happens if 100A applies? Things to know if 100A applies. Basically, first important point to note is that the amendment period for 100A is unlimited. So usually we would expect most taxpayers are under 2 or 4 year amendment period from the date of lodgement of the tax return or issue of the notice of assessment. If an amendment is required because 100A is applied, that amendment period is unlimited. So you're basically open to this forever. For the beneficiary that's a party to the 100A arrangement, they're deemed to be not presently entitled to that particular benefit. For the trustee of the trust, which is actually made the beneficiary presently entitled, they will now be assessed in full on the present entitlement amount and taxed at 47%. So emphasis here being is the trust and the trustee that is taxed on this amount, not the default beneficiaries of that trust. It stays within the trust. Now, this is all very well and good and all might be a bit scary, and now you're going to me, but what do you mean the ATO can come and amend my tax returns 20, 30 years later? It's unlimited. Well, how far are they going to go back and look? So since they've released all of this, the ATO have recognised that they probably don't have the resources to go back and look at everybody's tax return and every trust tax return lodged in any given year to make sure the arrangements are okay. So this is where the Practical Compliance Guiding, PCG 2022 D1, comes into play. So the ATO basically said they have limited resources. This is where we're going to focus our attention. So any arrangements that are pre-1 July 2014, the ATO generally won't look to commence new compliance activities unless there are, specific exclusions that might apply, specific reasons for it. For any pre-July 2022 arrangements, the taxpayers can look to apply previous website guidance that was issued back in 2014 if it's more favourable than what's in their PCG. But yeah, what they've also done, they've really tried to break down the arrangements and set it out in a risk assessment type framework by putting them into different coloured zones. So by putting them into the zones, you can figure out where your arrangements lie and what you should put in place, what you should expect in activity from the ATO. So we'll start by running through the different zones. So the first zone, and the nicest zone to be in, is probably the white zone. This is deemed low risk by the ATO, and they've advised that they won't commence any new compliance activities in relation to activities. And this is for all activities pre-1 July 2014, unless you are basically otherwise already under audit for the particular years. So they'll probably just have a look while they're there anyway. If you've entered into the arrangement before that 1 July 2014 date, but you've continued it after, there's potential they will still look at these low risk ones. And then they also might look at items in this zone where the trust and beneficiary were required to lodge returns, but those returns were not lodged until after 1 July 2017. So really, set number of arrangements that are 1 July 2014 and prior, but if you fit within one of those categories, you may get caught up and they might have a look. So the next zone that we're going to look at is the green zone. That's the next step up. So for those in the green zone, they're also low risk. The PCG provides examples of distributions to family members, ordinary dealings, and the retention of funds, which they consider low risk type arrangements. So if your circumstances are matching the examples that are included in the PCG in this section, it's probably worthwhile to document that, how they match up, having your proof there. Again, in this particular section though, the ATO have advised they won't be looking to apply any kind of dedicated resources into investigating these types of arrangements. So you might get a call from the ATO just confirming that your circumstances match the examples in the PCG, but that should be as far as it goes. So they're pretty low risk arrangements. The next step up is the blue area, which is the medium risk. This area always doesn't have its own definition. It's really those arrangements that don't fall within high risk and also don't fall within low risk. So they're really the green arrangements that maybe have a couple of, or one or two elements that maybe have a bit of a red, risk flavor to them. So any arrangements that kind of fall within this zone, they could potentially be subject to review by the ATO, but it's probably less likely than those that fall within the red zone. So if you've got an arrangement that's in the blue zone, potentially, take a look at it. Is there anything that can be done to reduce the risk of the arrangement? And just be ready. The ATO might give you a call to say, hey, can you explain the arrangement a little bit further, just so that we understand what's going on. And then the last zone, which is high risk, is the red zone. So arrangements falling within the red zone are really those where beneficiaries' entitlements appear to be motivated by kind of sheltering the trust's taxable income from higher tax rate beneficiaries. They're also the arrangements that may involve contrived elements, directing and enabling someone else to benefit from the present entitlement other than the person who was actually distributed the benefits. So elements, or the PCG includes a few examples of the types of arrangements that are covered under the red zone. So these include where presently entitled beneficiaries lend or gift some or all of the funds to another party, where trust income is returned to the trust by the beneficiary in the form of other assessable income, situations where beneficiaries are issued units by the trustee and the amount owed for the units is offset against the entitlement, situations where a share of net income is included in the assessable income. So in the assessable income of the beneficiary is significantly more than the beneficiary's actual entitlement. Also where the beneficiary presently entitled has losses, and then any arrangements that might be subject to a taxpayer alert. So in this particular situation, taxpayer alert 2022/1 was released at the time that the PCG was released, and that would be the type of arrangement that would fall into high risk. So any reimbursement arrangements that fall under the red high risk category, basically you should be expecting the ATO to conduct further analysis of the facts and the circumstances of that particular arrangement as a matter of priority. Once their analysis is complete, if it's confirmed to be a high risk arrangement, there is a good potential that it might escalate to an audit of the affairs. So I thought I would just run through a quick example if it's all a bit too wordy and confusing, everything that I've gone through. So the first example I'm going through is going to be an example that's within the green zone. So with this particular example, we start with Greater Trust. Greater Trust derives $150,000 of trust income in this particular year. The trustee has resolved to distribute $18,000 to Danny, and Danny uses that to pay her university fees. The balance of the distribution is sent to Mr. Great and Mrs. Better. They're distributed the balance. They don't call on the distribution of the funds as they're needed to stay in the trust, and they basically support the business of the Greater Trust. So in this particular scenario, in terms of the distribution to Danny, we don't really have any issues. The distribution has gone to Danny. She's received the benefit of her distribution by the payment of $18,000, and she's used it to pay her university fees. With Mr. and Mrs. Great, they've also been made presently entitled to income, but they haven't drawn upon it from the trust. But if you remember correctly, one of the reasons that arrangements might fall within the green zone is if funds are retained in the trust to support the working capital of the business, which is what's happened in this particular scenario. So for this particular trust distribution in this example, we would just be wanting to document our arrangement, note how it fits with the PCG examples of retention of funds, and go along our merry way. If the ATO ever called, we probably wouldn't have a problem. And then the second example I will quickly run through is one that's just falling within the red zone. So in this particular example, we have a trust which derives income of $240,000. The trust lends $240,000 to Bronwyn, who is the mother of two boys, Simon and Sam. Now the trustee resolves to distribute the $240,000 of income for that year to Simon and Sam. The trustee then applies the funds distributed to Simon and Sam as repayment of Bronwyn's loan. Bronwyn then pays the tax liabilities of Simon and Sam. So what we really have here, what you can see, Simon and Sam are the beneficiaries that are made presently entitled to the income of the trust. But these amounts are never really paid to them. They've been applied to repay Bronwyn's loan, meaning they're not really receiving the economic benefit of the present entitlements that have been made to them. Now, if you remember from the earlier slide, one of the red zone examples that was actually covered in the PCG includes circumstances where beneficiaries, they lend or gift some or all of the funds to another party. So here we have amounts applied for the benefits of family members. We would expect this type of arrangement where Simon and Sam haven't really received the benefit, it's all gone to Bronwyn, would definitely come under scrutiny by the ATO and draw the attention and fall within the red zone. So if there are arrangements like this in place, maybe proceed with caution. Definitely have a look at whether this is something that should be proceeding. So what now? 100A. Basically, keep in mind the PCG and the tax ruling that were released earlier this year are still in draft, but they do represent the ATO views on 100A. So, they should be kept in mind, and I guess apply both of them to your particular trust distribution arrangements and make sure that you fall within the low risk zones. So as part of, within the firm, as part of any work that we're doing at year end now, notes will probably be added to the file, just reviewing any historical agreements, making sure we fit within the right zones within the PCG, having those notes ready to go. The current year, again, making sure that presently entitled beneficiaries are selected appropriately, and we're not going to fall within any red high risk zones in relation to 100A. If you get more questions from your advisor this year, I guess don't be surprised. It might happen. And I guess that takes me to the end of the presentation for today. Thank you all for joining me. If I can remember how to get the tab and the screen working, I can potentially take any questions in the chat pod. Maybe beyond me. But if you do have questions and they're in the chat pod, I will be able to contact you via email or give you a call. If that's it, have a good day, guys.